Hello from Compound Wealth. We are SEBI registered mutual fund distributors. Today we are going to be talking about the 5 top rated equity mutual funds which are displayed on the screen at the moment. We posted about these funds in our YouTube shorts. The YouTube shorts had a brief overview about them. The DSP India T.I.G.E.R fund, the Invesco India Small Cap fund, the Mahindra Manulife Small Cap fund, Kotak Multicap fund, and the ICICI Prudential Focused Equity fund. So how did these 5 funds make the cut? These were filtered on the basis of 3-year CAGR sorted in descending order, and we excluded mid caps, which we will cover in the next video. And these were the 5 funds that came up top. As you can see, there's one infrastructure thematic fund, 2 small caps, 1 multi-cap fund, and a focused fund. Let's start at the top with the DSP India T.I.G.E.R fund. T.I.G.E.R stands for the Infrastructure Growth and Economic Reforms Fund. It was launched in June 2004, which makes it one of the oldest thematic funds in India. At just 22 years old, it is topping the top rated list. The benchmark is the BSE India Infrastructure Index. The direct plan has an expense ratio of 0.7%, which is reasonable for a thematic fund. The mandate is strict. At least 80% of the money goes into companies that gain from infrastructure growth and economic reforms. The person who runs the money is Rohit Singhania, who is the co-head of equities at DSP. He has run the same fund since June 2010, 16 years on one mandate and 25 years in total experience. He joined DSP back in 2005 as a portfolio analyst, and before that he was an equities analyst at HDFC Securities. He may be loyal, but does the tenure show up in the results? Look at everything Rohit manages. This fund is his best performer, nearly 23% CAGR a year over 5 years. His natural resources fund did about 15.5%. Large and mid cap and the tax saver around 13 each. I hope you can see the pattern. His alpha is strongest exactly where his sector knowledge runs the deepest. A manager winning on his home ground. If you see the fund's performance snapshot, the money in this fund has roughly tripled in over the last 5 years. The 1-year returns are around 12.3%. The 3 and 5-year CAGR returns are around 24%. The investment philosophy is to have a stake with the builders of India. It's to ride 2 engines at once: government infrastructure spending and the private capex revival. To stay valuation disciplined inside the theme and rotate whenever the risk reward is better. Because of this stellar performance, the report card is also stellar. Value Research gives it 4 stars and Morningstar gives it 5 plus the Gold Medalist badge. The outlook for this fund is that government capex is strong, corporate balance sheets are the cleanest in 20 years, and private capex is finally waking up. Fund 2 is the Invesco India Small Cap fund, the quiet compounder that most people scroll past. So here's the whole story in numbers. The fund was launched in October 2018 at 10 rupees and it is 52.6 rupees today. That is a 5.3x multiple in under 8 years. The fund manages about 13,500 crores and is benchmarked against the BSE 250 small cap index. The expense ratio of the fund is about 0.42%, which is quite lean for the direct fund. The fund manager is the Chief Investment Officer himself, Tahir Badshah, and he has been running the fund since day one. Around 30 years in Indian equities. Before Invesco, he headed equities at Motilal Oswal AMC for 6 years and earlier worked at Kotak Investment Advisors and ICICI Prudential's PMS. When a CIO personally runs a small cap fund, the house is telling you where the heart is. So has this team delivered? Let's see in the upcoming page. The fund has given roughly 24% a year since inception on the direct plan. 5-year returns are around 21.7%, and that window includes the brutal 2025 small cap correction. The fund held its Morningstar Gold badge right through that fall. In small cap, surviving the bad years is worth more than shining in the good ones. And to give you an overview of the performance snapshot of this fund, 1 lakh invested in this fund since inception is more than 5 lakhs today. And as with all equity funds, the more you stay invested, the more compounding works in your favor. The philosophy of this fund is to pick bottom-up quality stocks, businesses with scalable growth, and have hard filters on liquidity, leverage, and governance. In the small cap world, avoiding accidents matters more than finding multi-baggers. The ratings are a clean sweep here. It's a 5-star from Value Research and 5-star from Morningstar as well, plus a gold rating. For the road ahead, small caps have digested an 18-month correction. Smaller company earnings are picking up, and 125 basis points of rate cuts historically help exactly in this segment. Fund number 3 is the youngest name on the list, the Mahindra Manulife Small Cap Fund. It's around 3.5 years old and already sitting at the toppers table. Launched in December 2022. It's about 4,500 crores in size, the same benchmark as Invesco, and a 0.53% direct expense ratio. Now here is the underrated part, the size. At 4,600 crores AUM, this is the smallest fund on the list, and in small caps, small is a genuine advantage. A nimble fund can build and exit positions in less liquid stocks without moving the price against itself. It quite literally gives this fund space to dance. This fund is led by fund manager Krishna Sangvi, who has 3 decades of experience in Indian equities. He has had the reins since October 2024. So in this fund's first lap, 10 rupees at launch is 22 rupees today, about 25% CAGR since inception. It beat the small cap category average through the 2025 correction, but I will be straight here. The fund has not yet faced a full bear market as a mature portfolio. So going over the performance, the fund has given about 11.5% over 1 year, about 21.6% CAGR over 3 years, and no 5-year number exists because the fund is simply too young. And since launch, the fund has roughly given about 25% CAGR. It has been top quartile from day one with a short history. The fund's stated objective is almost boring, and I mean that as a compliment. It has appropriate diversification, low risk on business quality, no oversized single stock bets, and it has growth at reasonable valuations, no momentum chasing. Value Research gives this fund a 4-star and Morningstar gives this fund a 5. For the road ahead, the fund has hopes on earnings-led small cap recovery through capital goods, financials, and healthcare. My honest watch point is that today's small size is the edge. I mean, a double-edged sword if you ask me. I'm going to quickly pause here and ask you, which of these 5 mutual funds do you own? Tell me in the comments. Fund number 4 is the Kotak Multicap Fund, the biggest fund on this list and the most disciplined by design. This fund was born in September 2021, almost at the exact top of the bull market, possibly the worst birthday an equity fund can have. Remember that as we go through the numbers. So it's 28,000 crores today, the largest on our list, benchmarked to the Nifty 500 Multicap Index. What makes this multicap category special is that SEBI's rules force at least 25% in large mid caps and small caps at all times. The fund manager is Devendra Singhal, and he can never hide fully in large, mid or small caps when things get scary, and can never overchase any segment in euphoria. This gives the fund a structure to buy low and sell high. Devendra is a bottom-up stock picker, and he has had more than 2 decades with the Kotak Group. Across Devendra's actively managed mandates, this fund has done 17.65% CAGR a year since inception. His multi-asset allocation fund over 19%. That has given gold's outperformance this year. So as per the fund's own numbers, it's given 8.7% over 1 year, a soft patch, and this will be more better explained why in the market section. Over 3 years, it's given nearly 21% annually, and now recall the birthday. Launched into the September 2021 peak, it still compounded at 17.6% year on year. Surviving a bad start is one of the best stress tests a fund can pass. The investment philosophy is to have India's market cap curve in one disciplined portfolio. The 25-25-25 structure forces counter-cyclical rebalancing. Stock selection keeps the portfolio's PE below the market while its earnings growth stays above it. This fund has a 5-star rating from Value Research and 5 stars from Morningstar. The manager's outlook is that he is constructive on India over the next 3 to 5 years. Large caps are reasonably valued, and the premium on mid and small caps will be backed by earnings growth. Now moving on to the last fund, that is the ICICI Prudential Focused Equity Fund, the Sniper, the 30 stocks maximum fund. The scheme has run since May 2009, 17 years now, with 16,000 crores in assets under management against the BSE 500 as the benchmark. Right now the book is tilted towards large caps like ICICI Bank, Infosys, Axis Bank, HDFC Bank, and Britannia at the top. The manager is Vaibhav Dusad, in charge since 2022. 15 plus years in Indian equities with deep expertise in IT, telecom, internet and pharma. He also runs ICICI Prudential's Technology Fund, which is the largest tech fund in India, and the Innovation Fund. All told, roughly $2.5 billion under his management. His scorecards appear to be cyclical. This fund has given nearly 18% CAGR over 5 years. The Innovation Fund about 23.5% annually since its 2023 launch. The Technology Fund just 6% over 5 years, and that is context, not criticism. Global tech has been in a down cycle since the 2021 peak and the AI boom. Now for the fund's numbers, and one of them needs explaining. Just 3% over the past year. Why a defensive, large cap financials heavy book in a year when the rally was narrow, but look deeper, 20.5% a year over 3 years, nearly 18% CAGR over 5. And that stat that we should pay attention to is the alpha of roughly 5.7% per year over the BSE 500 with a beta below 1, beating the index by 5 points while taking less risk than the index. That is the entire job of active management done. The fund's investment philosophy is to have fewer stocks, have deeper research, and patience. Every pick runs through ICICI Prudential's BMV framework, which is business management and valuation. The rating agencies give this fund a 5-star. This fund's outlook is that when foreign investors return, they will buy India's most liquid quality names first. So now that we're done with the 5 fund deep dive, here is an SIP table. So 10,000 rupees a month every month for 3 years invested. So a total of 3,60,000 per fund. DSP Tiger turned it roughly into 5.1 lakh, and the bottom of this top 5 ICICI Prudential Focused Equity gives about 4.71 lakhs. So which fund is for you? The same 5 stars, very different jobs. Tiger is a satellite holding for investors with conviction in the infra cycle and have a holding period of about 5 to 7 years plus. Invesco Small Cap is also a satellite holding for patient investors who want proven small cap compounding over 7 years plus. So as you can see, different funds serve different investor needs. You might also be thinking, so is it a good time to invest? There are many things that are in favor of Indian equities, like RBI has cut interest rates, mid and small caps have digested an 18-month correction, and corporate India's balance sheet is the strongest in 20 years. So keeping all this in mind, the wins are definitely in our favor. Also, large caps have looked the most attractive that they have in a decade. That's another point in favor of investing now. The other signs of us having a resilient economy is that small caps roughly hold about 21% of total market cap against roughly 11% back in 2015. Better than last year, but it's not cheap at the moment. The crosswinds we have been facing since June is the West Asia conflict, which is now de-escalated, and Brent crude fell from above $92 to around 73. The 10-year GSEC eased to around 6.76%, while foreign investors were still sellers. About $3 billion went out of Indian equities in June alone. So is it a good time to invest? My answer is it depends less on when you invest and more on how you invest. Ratings are a report card of the past and not a forecast. Funds move in and out of 5-star lists. So match every fund to your own goals and risk appetite, and ideally sit with your distributor or advisor like us. If you want help turning this into an actual plan, a portfolio and not just a list, this is exactly what we do at Compound Wealth. Start your SIP with us at compoundwealth.in. The link is in the description. A disclaimer here. Mutual funds are subject to market risks. Read all the scheme related documents carefully. Past performance may or may not be sustained in the future. If this breakdown earned it, subscribe and tell me which fund you want on the table next. See you in the next one.